whenever we talk about the school and education, there's a concept, and earlier I talked about this concept in another webinar, which is tax credit versus deduction. And every time there is some kind of tax incentive, the very first thing is for you to know whether it is tax incentives on what. So the answer need to be that either on deduction or on credit. When they talk about credit, it simply means that it is credit is reversing the tax dollars, right? And when you say deduction is reversing income. So if it is the same dollar, $100 for deduction is not the same as $100 for tax credit. Because deduction $100 reverse your income for $100. If your tax rate is 10%, only save you $10. But $100 tax credit means reversing the tax you're supposedly paying for $100. Now you don't pay because it reversed it. So it's literally representing $1,000 of your income, right? So this is where we want to clearly define the deduction and the credit. And here you have this, we have a topic called the school and education treatment. Number one, student loan. Number two, education credit. This is tax credit. Number three, tuition fee deduction. This is income deduction. And number four, 529 college saving plan. What does that mean to me, right? And the textbooks and tuition credit. This is tax credit. And then education subtraction credit for Minnesota. And this is again credit and the deduction. Okay, they call them subtraction. It's really just deduction. So now let's cover all of them. And before I go forward, of course, no responsibility disclaimer, and please take information with grain of salt. And let's go to student loan interest deduction. And this is interesting because in 2020, and there was a 0% loan interest imposed. So most of the folks should not have federal student loan interest, that 1098 that you used to get. So what is the qualified student loan that you can't deduct the interest? If you borrow money from your mom and dad and you go to college and you have an interest, that's not deductible. You cannot bring that to your tax return. The only one you can do is what we call qualified. How do you know that is qualified or not? That must be qualified student loan for the benefit of you, your spouse, and your dependent. That means it has to be qualifying. It has to be benefiting one of the person on your tax return in order to qualify. And if it is the employer or your family friends provided, doesn't qualify and must be used to pay for qualified education expenses such as tuition, room and board, books, and supplies and equipment. And this is where a lot of people, I have a lot of questions not related to tuition because they know that's qualified, but they're wondering about room and board. So right here, it is qualified expense. And then who can be eligible for that? Know that if you are married and you file separately, then you automatically disqualify for that. There's other benefit you will give up, okay? When you do married file separately, and must be legally obligated to repay the loan. What does that mean? That means that the student loan must be, you obtained it and you are paying for it, cannot be someone else's student loan, you are paying for it. And of course, a lot of times mom and dad guaranteed the loan and the kids has student loan, mom and dad paying for it, yeah, you can deduct it. Amount of tax deduction maximum is $2,500 for 2020. And it can be limited to your income. Here you see, I have this income threshold here. And those are very difficult to remember. Normally people don't quite remember the threshold, but if you don't use your hand to calculate, You would never make a mistake on that because the computerized system will make sure that you don't, you know, if your AGI is high enough and they don't let you do it. And here you saw I introduced the MAGI. This is a concept that called a modified adjusted gross income. If you have a foreign properties or income from foreign sources, and you need to calculate MAGI, not just AGI. So it's just a general concept, and you need to be aware of student loan deduction, and you can deduct it in two places. In above the line, which means above the adjusted gross income, you can deduct, or you can deduct in your schedule, in your itemized deduction, and deduct it over there. So you have a place to deduct, but this is not a credit, right? It's not a credit deduction. It is an income deduction. So now we cover the number one item, and the one small things I need to make a comment here is related to COVID-19. All federal student loans are currently 0% interest and they require no payment through September 30th, 2021. So if nothing changes, you'll get a little bit for the last quarter. Federal student loan interest rates are currently at a record low. That means they're really very minimal. Beginning on July 1st, 2020, the rate is 2.7, and the graduate loan rate, this is undergraduate, is 2.75, and the graduate is 4.3. So it's the rate is lower, plus you don't have to pay until the third quarter ending in 2021. So much about student loan and the federal education credit. There's two items in here. One is called American Opportunity Tax Credit. The other one is Lifetime Learning Credit. The American Opportunity Tax Credit, the character on that one is to say that that one has a time limit. You can only claim it 4 times. But lifetime is no limit. You can claim it as many times as you need, right? So you must meet 3 requirements in order for this tax credit. So number one, you, your spouse, or third party pays qualified education expenses for higher education. So this is not K-12. This is higher education. An eligible student must be enrolled at eligible education institution, which are the institution who gives you the 1098T. Okay, and most of them are, and I haven't really come across one which is not eligible for that, because obviously when you take higher education, you're going to take one with is properly registered and be able to issue you 1090-T. Of course, you may be doing university outside of US, then they don't qualify for that. The eligible student is yourself, your spouse, or dependent on your tax return. So if you fit all of these, you're good. And now, and who cannot claim? Who cannot claim? Someone such as your parents list you as a dependent on their tax return. If you are dependent on your parents' tax return and you need to have that credit goes to your parents, and it's not you because you are filing a dependent tax return. You're not independent, so the credit doesn't come into play. If you do married file separately, that we kind of mentioned that, and you already claimed or reduced another higher education benefit using the same student or same expenses. So basically it says that even though you may be taking, maybe you're doing school at the same time at Stanford, then Harvard, you're a genius. You do your school at 2 places at the same time. And too bad, and you can only do one. So that's what it says. Okay, and if you are a non-resident alien for any part of the year, did not choose to be treated as resident alien for tax purposes, you cannot take that. So what that means is that, let's say if I'm a foreign student from China, I'm still filing 1040-NR, then you don't qualify for these credit. Now, American Opportunity Tax Credit, and this credit is paid for eligible expenses for student for the first 4 years of higher education. So you can get a maximum equal annual credit of $2,500 per eligible student. If the credit brings the amount of taxes you owe to zero, you can have 40% of any remaining amount of the credit refund to you. So what it says is that if you pay taxes for 2,500, you get it all back. But what if you pay taxes for 1,500, you have 1,000 these credit and you don't have taxes to offset? What it says here is that they give you for $400 because you can have the 40% of the leftover. So that's what it says. So basically, if you are paying taxes, these 2,500 will come to you 4 times, okay, while you're in school. And this is say who is eligible, and it really doesn't have anything too earth-shattering. It's really common sense. And then it says, what are the income limitation? Again, must be 80,000 or less. If you're married, is 160,000. And here again, it goes on MAGI. The reason it is here is because obviously, if you are a foreign student, but you elected US to be your tax residence home, and then you need to include your home country, the money and the asset that you have in order to see whether you're over 80,000 or not. Okay, folks. And then the next one is lifetime learning tax credit. And the lifetime learning tax credit, and this one is no limitation in the year, just like the name suggests. It is going to go with you lifetime, as long as you want to be in school, as long as you are more, you have the check mark saying that more than half time, and then you get that. And here is the amount, the limitation for that. The amount is 2,000 tax credits. So right here, there's no limit on the number of years you can claim. It is worth up to 2,000 per tax return. It is not refundable, means that if you don't even pay taxes, you're not going to have that coming back to you. But if you paid 2,000 or more taxes, the $2,000 come back to you. You don't have to pay. So say if at the end of the tax season, the tax filing time, and you owe $3,000 taxes, and then you go, oh, look, I have this lifetime tax credit. I did not even tell you. Here is my tuition slip, and I get $2,000 tax credit. Then your bill for IRS is not 3,000, it's become 1,000. So this is where we're talking about tax credit, right? So lifetime also have an income limitation, and it is if your MAGI, okay, modified adjusted gross income is between 59,000 to 69,000. It is tapering off gradually. So 69,000 is the top line. Then you will lose all of that. Now let's talk about, so what did we do? We just did 2 tax credit, right? American learning tax credit, lifetime learning tax credit, and one is 2,500 tax credit per year for 4 times. The other one is $2,000 tax credit for no limitation, and those are reducing my taxes. Now let's talk about tuition fees and tax deductions. This one is tax deduction, means is offsetting your income, and offsetting how much? It is $4,000 per year income. So if your tax rate is 20%, then it's $800 tax saving. So it's no comparison to the tax credit, but it is a deduction. And the good part about the deduction is that, you know, if you have this deduction, and you may be not qualifying for the credit because you are really sporadically study and just a little bit at a time, you are not qualified to be taking the credit because you're not full-time student. And then you can do this tax deduction, and that would allow you to deduct regardless you're part-time, full-time, right? So there's in most of the tax programs, the program itself will build in what we call the optimizer, right? So they will help you to calculate which one is better. So in our firm, when we have parents and start having kids going to college, and of course this is part of the planning we do, and to know that the parents may be having too much income, there's no way those tax credit deduction would make any sense. Then what we do is we look at the children, whether they can file their own tax return instead of becoming the dependent of the parents. So making money on their own, then taking all these deductions. So this is really, once you have kids, I think it's your responsibility to make sure that you are taking the best out of these three scenarios, right? Try to run your return with all three scenarios, 2 credit, 1 deduction, and see which one would work for you. Other than that, other than this, the tax credit and deduction, there is something called 529 college saving plan. I know everybody knows that. When you have a little kid, there are people, when the baby is born, they already start doing 529. So 529, just keep in mind, they are state sponsored program. It's a qualified tuition plan sponsored by state. The state agency or the educational institutions are authorized by this section of 529 of Internal Revenue Code. So it is the IRS thing, and saying that if you have this 529, we have certain benefit for you. So the benefit for contributing to 529 is different state by state. So in here, we will just cover the Iowa and the Minnesota. So you can deduct the contributions from the state income tax. Of course, there is every state is a little different, but generally speaking, what you put into 529, you don't pay state taxes. State income taxes you don't pay, and may only be able to contribute in a 529 plan sponsored by your state. What it's saying here is that if you, let's say I live in Iowa, but my kid has ambition to go to California to study at Stanford. And ever since my kid is born, I knew that's gonna be the end of it. And buying Iowa 529 plan may not be a good idea because that is just for the state, just for the state institution. So you want to look at the 529 plan to make sure that your state allow you to pay tuitions outside of the state. And then you can deduct it here in your tax return, right? And then also for 2021, Iowa allowed 3,474 per child, per parent. That means if the child has 2 parents, and then it's 2 times of that, that means almost $7,000 income don't need to pay state taxes. Iowa state taxes, you can average that to 8%. If it is 7,000, that's a $1,500 saving right there in tax dollars. And Minnesota has 2 ways of to reduce your 529. You can either do income deduction, or you can do the credit. The credit is $500 per child, and maximum. That's the tax dollars. And the income is different by whether you are filing single or joint. So it's 1,500 per child. So it is a different rules. So you want to make sure that you know which one you are going about when you contribute to 529 plan. So you want to find out how the taxes deduction would be, and whether it is a tax deduction or income deduction, or both. If it is both, which one is better, right? Then you want to know that once you put money in the 529 plan, what if your child don't go to university in Minnesota? What about your child go to Harvard? And you want to find out that and make sure that you contribute to the right 529 plan, or you don't contribute to 529 plan. I have a client that who had a kid, and instead of contributing to 529, and he was buying properties, so he would name the property for each of the kids for the college. So when the college time come, he'll sell the property that will become the kids' tuition. Of course, you can do that. The property will appreciate, right? Now, so here there is a little bit of tips in terms of withdrawing 529 plan. The earnings, we talk about 529 plan getting deducted at the state level, but we didn't really say much about federal, right? But the benefit for 529 plan is that if you bought 529, if you put in $100 and it has become $100, it's become $100,000. As long as you use the $100,000 for kids' tuition, those qualified expenses, your earning inside of 529 plan is not taxable. So you just get it paid directly to school and you don't pay taxes on that. So this is where the benefit we're talking about. Okay, but if you withdraw, let's say if you withdraw early or your kid was spending the money not on the qualified college expenses, then you would end up paying 10% penalty for the withdrawal. All right, tuition and textbook credit. This is for Iowa. So in Iowa, it doesn't matter how much money you spend. And as long as you spend more than $1,000, you will take $250 tax credit for each kid, K to 12, okay? And Iowa has a really detailed eligible expenses, say what can be used to count into that expense. Because 1,000 maximum, then you can get $250 tax credit. If it is 500, then you only get 175. So they do 25% on the first $1,000 qualified expense. So books and instructional materials, and that is in commonly taught in Iowa school, that's eligible. And the non-street clothing for play and special concert, eligible. Driver education, eligible. Due fees, admission paid for extracurricular activity, eligible. Okay? And piano lessons is extracurriculum activities. Okay? Tuition for school, of course, uniform, fees for transportation. So those are eligible. But what is not eligible? Yearbooks, textbooks, fines, you just destroy the book, they charge you. And the clothes which can be used for streetwear. So it's like common clothes now, right? Driver education paid to other than K to 12 school. And so those are things that travel expenses for overnight trip, which involves payment for meal and lodging. So it tells you that what is not eligible for that $1,000 expense. So Iowa has a pretty detailed rules. Let's look at Minnesota. And Minnesota has two things in place. The first one is the deduction. They allow to deduct $250 from your income for K to 12, for 7 to 12, but $1,625 for K to 6. So they have a different tiers, depends on how big your kids are. Expense qualified for deductions are tuition, including non-public school and after-school enrichment, academic summer camps. Come on, folks. So summer is here. Make sure you save your receipts, right? Music lessons and tutorings, textbooks, and the transportation. See, there's no limitation on transportations. Unlike Iowa, they limit overnight transportation, and this one didn't have any limitation. And the credit is for up to 1,000 for each child in grade K to 12. So listen to this. We were talking about deduction, right? This is reducing your income. So you're going to count that in your income reduction. And you know that is 2,500 for bigger kids. And for the smaller ones is 1,625. But there is another deduction. It is 1,000 per child in grade K to 12. There's no difference now, K to 12, and you can take the $1,000 tax credit. That tax credit is tuition fee, look at this. So these are the same. The first three are the same with expenses, except the payment for non-public school tuition. So they don't give the tax credit for non-public school tuition. What is non-public school tuition? Those are the private schools, right? And so those are the school tuition. They are not allowing you to claim the credit. So for Minnesota school, you have two ways to do your deduction. So you can do it on the income deduction. You can also do it on the education tax credit side. So this gives the overview of what we are looking at for our school, for our topic of school and education. So if we just kind of absorb what we learned today, so we learned that the education treatment, expense treatment can be different with each state. So if you move a state or you are, you are new to the state, you want to learn which part they have what in the state. Other than that, they also allow you on the federal side, they also have all of these things available. Interest expense deduction is available. And then you have two credit, right? The American Learning Credit and Lifetime Learning Credit. And then you also have this tuition fee deduction. And so those are the ones available at the federal side. The federal government give you 4 opportunities to handle your education expense: interest deduction, American Learning, Lifetime Learning, and the tuition fee deduction. Those are on the federal side. And when the federal side is reducing, your state is also reducing because most of the state carries the federal AGI to the state. So your tuition deduction, that would show up on your state as well as a reduced total already. Then on the state side, you have the 529 plan. That is sort of both in the federal and in the state. State side, you have a treatment to reduce your taxes. On the federal side is your withdrawal. When you withdraw that money, the earning, you don't pay taxes, both on federal and the state side. So this would give you a total overview of the tuition, payment, learning. As a parent, you want to plan that carefully. Plan that with your tax return in mind, because depends on where you are in terms of your lifestyle, and that could dictate the difference for your children. So if you have any comments, remember, you can always go to our website, right? Go to our website to register for our webinars, and also go to YouTube channel. And this is the famous YouTube channel that we have, and you can find everything we talk about here, over here. And subscribe to our channel so you can be informed all the time. All right. Good to see you and talk to you more. Bye-bye.